All right, let's dive right in. Today, we are pulling back the curtain on the language of the Forex market. You know, all those terms that can feel a little intimidating at first? We're going to break down everything, from pairs and pips to lots and leverage, so you can look at a trading screen and feel total confidence, not confusion. Let's get to it.
I mean, we've all been there, right? You see a quote like this, just a jumble of letters and numbers, and you think, what on earth is that supposed to tell me? Well, if that's you, you are in exactly the right place. That little string of text is the DNA of every single trade, and I promise, by the time we're done here, it's all going to make perfect sense.
So, here's our game plan. We're going to build this thing from the ground up, nice and logical. First, we'll figure out what that currency pair actually is. Then, we'll get into how its price moves and how you measure your trade size. After that, we tackle the big stuff, leverage and risk. We'll look at the hidden costs, and then we'll wrap it all up with a super simple checklist to use before you even think about placing a trade.
Okay, first things first. Before you can trade anything, you've got to know what it is you're actually trading. And in Forex, that all starts with understanding the currency pair. You know, a Forex pair is really just a price tag. It's that simple. So when you see Euro USD at 1.1000, the market is just telling you that to buy one single euro, it's going to cost you $1.10. It's just a direct comparison of value between two different currencies.
Now, how these two work together is absolutely key. The first currency you see, the one on the left, that's the base currency. Think of it as the thing you're buying, the one unit. The currency on the right is the quote currency. That's what you're using to pay for it. So, and this is important, when you click Buy on EURUSD, you're making a bet that the euro is about to get stronger compared to the US dollar.
And have you ever noticed it's always Euro/USD and never the other way around? Well, that's not an accident. There's actually an unwritten rule in the market, kind of like a pecking order, for which currency comes first. The euro is the king of the hill, outranking the pound, which outranks the Aussie dollar, and so on down the line. It's just a market convention.
Okay, so we get the pair itself, but let's be honest. We're here because prices move. That's where you either make or lose money. So the big question is, how do we measure those teeny tiny constant fluctuations?
The answer is something called a pip. It's short for percentage in point, and it is the universal yardstick for price changes in Forex. So for a minute, forget about dollars and cents. In this world, we talk in pips.
Now here's a detail you absolutely have to get right. Where that pip is located depends on the pair. For most major pairs, like the euro-dollar, it's the fourth number after the decimal point. But for anything involving the Japanese yen, it's the second decimal place. This is such a common trip-up for beginners, so really lock that one in.
So, what is that tiny little 0.0001 movement actually worth in real money? How does this abstract pip turn into cash in your account? Well, for a standard trade size, and we'll get to what that is in just a second, a single one pip move is worth this, $10. This is the moment it stops being theory and starts hitting the bottom line.
Now, that $10 value isn't just pulled out of thin air. It's directly tied to the size of your trade, which, of course, brings us to the next big question: how do we even measure the amount of currency we're traded?
See, in Forex, we don't trade €1 here, $1 there. We deal in standardized quantities called lots. A lot is basically just a batch size. It's the industry standard for measuring how many units of that base currency you're actually controlling.
And here is where it all clicks. A standard lot means you're controlling 100,000 units of currency, and that's what gives us that $10 per pip value. But look at the other options. A mini lot makes each pip worth $1. A micro lot, just 10 cents. This is so powerful because it means you can scale your risk up or down to perfectly match your comfort level and account size.
All right, let's be real for a second. Controlling 100,000 euros, that sounds really expensive. So how on earth is a regular person supposed to do that? Well, this leads us to the most powerful and, frankly, the most misunderstood concepts in all of trading.
This is the million-dollar question, isn't it? You see people controlling these huge positions, but it's not because they have a massive bankroll for every single trade. No, there's a special mechanism at play here.
And the answer is leverage. The best way to think about it is like a tool your broker gives you that multiplies your purchasing power. The margin is just the good faith deposit you have to put down to access that tool. So for example, to control a position worth about $110,000 with 100-to-1 leverage, you only need to put up about $1,100 of your own cash.
And this brings us to the single most important lesson about risk. Leverage is a total double-edged sword. Yes, it magnifies your position size, which is great for profits, but it also magnifies your losses just as much. A bigger lot size means every little pip move rocks your account balance way more. This is why the absolute golden rule of trading is to always decide how much you're willing to risk before you even think about your position size.
Okay, nothing in life is free, and that includes trading. Just like any other business, there are built-in costs. And to make a profit, your trade has to climb out of that hole first.
The number one cost you'll face on every single trade is the spread. It's just that tiny difference between the buy price and the sell price. That little gap is essentially the broker's fee for the transaction, and it means that the very second you open a trade, you're starting off with a small, built-in loss that you have to overcome.
So when you add it all up, there are three main costs you got to watch out for. First, the spread. That's on every trade, no escaping it. Second, some types of accounts also charge a separate commission fee. And third, if you hold a trade open past the end of the day, you might pay or even receive a small fee called a swap, which is all based on interest rates.
Wow, we have covered a lot of ground. So now it's time to pull everything we've learned together into a simple, practical checklist you can run through before you even think about clicking that buy or sell button. Here it is, your pre-flight check. Step 1, always double-check the specs for what you're trading. 2, know exactly what one pip is worth in your own currency. 3, add up all your costs so there are no surprises. 4, try to trade when the market's busiest, because that's when you get the best pricing. And finally, the most important one, step 5, always decide your maximum dollar risk first, and then work backward from there to pick the right lot size. That single habit is the key to survival.
And there you have it. You can now look at a trading screen and actually speak the language. You know what pairs, pips, and lots really mean. You've gone from seeing a bunch of random numbers to understanding the value and the risk behind them. So we'll leave you with this final thought. Now that you can decode the screen, what's the one thing that's still holding you back? Thanks for joining us.